Imagine a major $39 billion fund house publicly declaring US markets are no longer a safe haven. This isn't hyperbole, it's a significant signal from institutional capital. For investors, advisors, and fund managers, understanding this shift is paramount. What analytical perspective drives such a cautious stance? Let's examine the data. But before we dive into why Wall Street's looking shakier than a house of cards in a hurricane, let's pause for a sanity check. This video took more breakdowns than the stock market in 2008, and editing it? Let's just say my PC almost filed for bankruptcy. So smash that like button, hit subscribe. A prominent $39 billion fund house has indeed raised serious concerns regarding US market stability. Their analysis points directly to escalating national debt and unpredictable trade policies as key risk factors. This isn't just noise, it's a data-driven assessment impacting financial reporting. The US national debt has seen a substantial increase, adding $2.4 trillion post-tax reforms. This fiscal trajectory raises analytical questions about long-term economic sustainability. Simultaneously, inconsistent trade decisions introduce significant policy uncertainty, complicating economic forecasts and investment strategies. This cautious sentiment is reflected in broader market movements. Institutional investors are demonstrably shifting assets away from the US. European markets, for instance, are seeing increased favor, suggesting a global reallocation based on perceived stability. The Stoxx Europe 600 index has outperformed the S&P 500 year to date, gaining 9% versus 2%. This performance gap provides financial reporting evidence of changing investor preferences. A recent Bank of America survey highlighted the largest underweighting of the US dollar in nearly 2 decades, a clear indicator of diminished confidence. Leading firms like Caisse, dépôt, placement du Québec and Neuberger Berman are actively increasing their European exposure. They cite political stability and consistent macroeconomic conditions as attractive attributes. This trend underscores a growing analytical skepticism towards the US market's ability to deliver stable returns amidst fiscal and policy volatility. This strategic pivot by major players serves as a critical data point for market analysis. It suggests a cautious outlook on the US economic forecast. Financial advisors and fund managers must consider these movements when evaluating portfolio risk and potential returns. So, what are the implications for your investment strategy? Is this a temporary adjustment or a more fundamental shift in global capital flows? Analyzing these trends is crucial for informed decision-making. The current environment demands a cautious and analytical approach to portfolio construction and risk management. Evaluate your current US market exposure in light of these concerns. Consider the potential impact of fiscal and policy uncertainty on your financial reporting and economic forecasts. Analyze alternative markets and asset classes. Stay informed and adapt your strategy based on rigorous market analysis and data.